Welcome back. So this week, global markets were driven by the hopes that China's economy would pick up pace as COVID-19 restrictions ease. However, investors are cautious ahead of a week full of risky events, including the Federal Reserve's policy meeting, which could put a lid on the positive sentiment. But to help us look back on the week and throw ahead for the trading day on the JSE, we are joined by SABC News Markets presenter Nastassia Arendse. Nastassia, good morning. Welcome to the agenda.
Thank you.
So it's interesting, right? There was the expectation that with China easing restrictions, there'd be some positivity. We didn't see it. What are really the biggest takeaways then for markets this week?
Funny enough, that actually is the biggest takeaway for markets, because probably since November, we've been pricing in the fact that China's COVID restrictions would at least be eased. So it's quite interesting in how the market is interpreting the word eased, because they've managed to ease the COVID restrictions, but they still, let's call it, monitoring the situation. And markets are excited about it because we can actually start seeing, growth concerns that we had on China's economy start to at least alleviate a bit. But the problem is that we're now worried about inflation, because inflation has been the biggest problem this entire year, which would basically explain why a lot of the central banks have been trying to tame it by increasing interest rates. But then you have a lot of the analysts saying that we might expect inflation to come down slightly, at least global inflation next year. But then you have China reopening, which is a good thing, but a bad thing at the same time. Because
for global markets.
For global markets, because depending on how quickly they reopen, we could start seeing a wave of demand which starts pushing up inflation, because commodity prices start increasing, and you also start seeing inflation coming through on the services side, which employs young people in China. And one of the reasons we saw this easing of COVID restrictions was because it was the young people in China that were quite upset, because the youth unemployment rate in China started to spike 22% in July.
Sure.
And the services sector is the sector that employs a lot of young people. So analysts at this point, it's like, we're excited, we're pricing in growth, we're ready to have a bit of a risk-on approach to China, but we are concerned that depending on how quickly it opens up, we don't want to have inflation kicking in again.
Yeah, it's interesting. 22% unemployment in China sounds like a little in comparison to what our percentage looks like. But if you look at the population in China, that's actually quite a huge chunk of young people. Let's come back to South Africa. Yeah. Last week, one of the big stories has been the Section 89 report. We saw the Rand react, but the banks have reacted as well.
Yeah, so last week, the banks took probably a big hit, and we've seen them recoup some of the losses they had, but they're still quite low. And I think a lot of what happened last week was fear-based. It was around the sentiment around risk in terms of the uncertainty and where we're sitting. So outside of the political risk, there are still other risks that a lot of the local banks actually experience. And we've actually got a clip from Patrice Rousseau, who's the Chief Investment Officer at Ashburton. So in this clip, he outlines what the viewers should be paying attention to. So we'll play that now for the viewers, and I'll explain afterwards.
Let's take a look.
The banking stocks tend to be really the bellwether of the economy, because they land across economic sectors. But I think the key issue is interest rates in South Africa have increased quite substantially, given the number of jumbo 75 basis point hikes. So we've had rates which were closer to 3.5% a year ago, now at 7%. That's double. So that will put a lot of pressure on the average consumer who has floating rate debt, who has a mortgage, who has a car loan. You have GDP, which has rebounded somehow, but the problem is that a lot of businesses are still under pressure. So I don't think there is an ability for businesses to offer real wage growth. So with inflation being as high as it is in South Africa, I think wages are likely to lag behind, and companies are going to start to cut costs to be able to grow or maintain growth going forward. So I think the prognosis into next year is going to be very tough, just like we've spoken about the US. I think that would also be reflected in the South African economy.
So as Patrice just mentioned, a lot of the banks are bellwether for the economy. And the reason it's concerning is that this week we had a lot of the banks, at least say the top 3 banks, report their 10-month earnings for at least, well, the past 10 months. But they're going to be publishing their financial results in March next year.
Right.
So this is just a 10-month update to give the market a sense of what to expect. But there were key notable line items in the bank's updates. So we're going to put a graphic on screen which just shows you the quotes. I mean, building on what Patrice has said, that next year could be quite tough, at least in the first half of the year. You have Standard Bank saying that because of the increase in interest rates, which have gone from, say, 325 basis points to 7, we've seen they're starting to see increased impairment charges, especially when it comes to new businesses, pockets of consumer strain. Consumers now applying for debt review, which is quite scary. ABSA seeing, again, the interest rate increases. They're expecting credit impairments, and they're seeing it in their home loans, vehicle, as well as personal loans. So we haven't had Capitec and First Rand, which is the owner of FNB, release their 10-month update yet, but it will probably come through. But Nedbank also seeing little pockets. But what's quite interesting about Nedbank's one is that even though we are in a high interest rate environment, they're still giving out loans because you have customers that are trying to at least supplement short-term expenditure, and as a result, they're applying for more loans. So it's a good thing for the banks because they net interest revenue increases, but a bad thing for you if you have credit cards, a mortgage, or even a car.
I mean, it certainly is interesting times, right? And it really begs a lot of responsibility and careful reaction from consumers. Let's talk about central banks, big focus next week.
Yes, next week. So recently we've had the South African Reserve Bank have their interest rate decision. It was the last interest rate decision for the year. So next week we have at least the top 3 major banks, the United States Federal Reserve, UK with the Bank of England, and the ECB in Europe announcing their interest rate decision. So we're going to be watching a lot of that. The United States one is quite interesting because interest rates are supposed to be, their target is 2%. The expectation, which is quite interesting, that on Tuesday we have the US CPI figures just before the Federal Reserve's interest rate decision. So why I put these 3 sort of economies on the screen for you is that we were talking about China not too long ago.
Yes.
And we're all thinking that if we see inflation in the US peak, we'll start to see the Federal Reserve at least slow down the pace of interest rates.
Right.
So we're expecting 50 basis points next week, Wednesday. But the concern for markets is that when we start seeing inflation peak on the back of China reopening, that idea of what we call a Fed pivot, i.e. we are moving from aggressive to more of a dovish tone in terms of how we're choosing to deal with interest rates. We are less aggressive. That might not happen the way the markets are expecting it. So we could still see interest rates increase, but probably at the same percentage to deal with inflation if we start having these inflation problems come through. So it's a tricky one for a lot of the central banks. The Bank of England also trying to deal with their inflation. I think the inflation is 10%. They have a 2% target, so inflation is 5 times more. The ECB also having inflation problems. So let's see what the China narrative going into the first half of next year affects the big central banks, but also us as well.
Yeah, this is what I was going to say, is that it does give you a picture of what the governor with the South African Reserve Bank is battling with every time he comes and makes an announcement.
Yeah, and I suppose also all analysts are going to be focusing on the US CPI figure, which comes out on Tuesday, and the Federal Reserve interest rate decision on Wednesday. What we're going to be looking out for is the tone. Yeah. What is he forecasting in terms of his expectations for the labor side? Because labor has been quite strong. And the problem with labor being strong is that you have wage prices also increasing. That's stoking inflation. So we want to hear where's he seeing it going, especially looking at some of the data points that we've gotten out of the US. And then from there, we'll see what happens.
Man, listen, we're all dealing with the same problems, actually. Let's leave it there. Nastassia, thank you so much for your time. That there, SABC News Markets presenter Nastassia Arendse bringing us the data of what to expect from the markets and really what we should be doing with our pockets.